Hi, everyone. I'm Ramita from Vantage Realty. Welcome to our Home Insurance 101 meeting. Thank you so much for joining us. It is Tuesday, 11 a.m. With me, I have Albert Taylor and Jonathan Fong, insurance brokers from Farmers, as well as Tom Benducci, who is branch manager from Cornerstone First Mortgage. So I'll let them go ahead and introduce themselves, and then we can get started.
Well, I guess I'll get started first. First of all, I want to thank you, Ramita, for organizing this. It's really important that we get information out to folks with this ever-challenging insurance market, ever-changing insurance market. And thank Tom for coming on and really bringing the lender's perspective to this. We've been doing this for over 20 years with Farmers Insurance, and our office is located in Noe Valley. It's a family-run business. My wife, Lena, keeps us all in line and does a lot of the heavy lifting with a lot of our clients. Jonathan is an important team member. We've known him since pre-K. So it really is a family-run business. We're a full-line insurance brokerage, which we do, of course, home insurance, business insurance, life insurance, auto insurance. So we do, as we like to say, we do all things insurance for both individual and small business. And really, really happy to be with you today.
Hi, I'm Tom Banducci. I'm from Cornerstone First Mortgage. I've been lending in San Francisco since 2003, although that sounds really painful to say that. What I like about my company is I have a lot of different options for different people. We have a really big box and a lot of guidelines that can help self-employed people that can help have good rates and good service and quick turnarounds and everything that you need to do to have available to close loans in our wonderful, crazy market. So I'm happy to be here. Thank you.
Yeah, and then I'm Jonathan Fong. I work with Albert, and just to piggyback off what he said, I'm mostly working with our habitational clients, but we do everything. So whether it's HOAs, TICs, or apartment buildings, there's been a lot of changes in the industry that we'll get to later in this meeting, but I've been mostly spearheading that side as well as the rest of our business. So I'm looking forward to this meeting.
Awesome. Thanks so much, guys. So we will get started. We actually already have a question, which is pretty relevant to, I think, where we're going to be going with this. So let's start with kind of what precipitated this. As you all know, the insurance environment has been very challenging. So the question is, what changed? Why has it become so challenging the past couple of years? And E.T., do you want to take that?
Sure, I'll tackle that, and then if Jonathan, you want to weigh in. So I think it's really important to remember we started with the pandemic. So during the pandemic, everything shut down. People were kind of sheltered in their homes. They weren't going out and doing things. And the Department of Insurance instructed insurance companies that they needed to start refunding people's money. We in our agency got a lot of requests for lowering mileage and lowering coverages and things like that, since people were kind of stuck indoors. So once they started getting out, once the pandemic lifted and people started getting out of their homes, they kind of went crazy. Accidents kind of start going up. People are driving crazy down the road because we got that freedom. And the risks and losses started to mount up really fast. Now, the Department of Insurance did not allow insurance companies to adjust to that. The other thing that happened, which we're all kind of still feeling, is inflation. Things started to go up dramatically. So not only was claims starting to rise and lawsuits, but also inflation. The cost to repair and replace everything started going up quite dramatically. And so they're stuck with the old way of trying to figure out, go through the request for adjusting rates and things like that. Insurance companies started going extremely unprofitable. And I'm no fan, you know, I'm not here to represent any particular insurance company in terms of their philosophy, but the losses mounted and they became unprofitable. In fact, one of our competitors, State Farm, they recorded their largest loss in company history during that time. And so as these companies became more and more unprofitable and they're in jeopardy of losing their credit rating, and they were in jeopardy of being downgraded because they didn't have the reserves to pay claims. And so in order to stay in business, they had to start restricting coverage. And, you know, obviously if a business is making money, they want more of it. But when they're losing money, they have to stop and start restricting it.
And then along with that, ET, what have the insurance governor and insurance commissioner and governor been doing as far as you know to tackle these cancellations? And what can basically help with this situation?
Well, kind of as you know, so lots of insurance companies have withdrawn from the market still, and they're still continuing to withdraw. But the Department of Insurance and the governor has been kind of working to one, ease regulation. So they've now agreed to a more forward-looking forecast for forecasting losses. Before it used to be based on historical events. Now they're able to start projecting the catastrophes that may happen in the future using current modeling. The other thing that happened, which a lot of people don't realize, that insurance companies have to insure as well. It's called reinsurance. The reinsurance market got tight and rates were going crazy. They're now allowing insurance companies to start incorporating those reinsurance costs for California. So farmers, to their credit, they bit the bullet and took rate and did a lot of things ahead of time, and they're starting to come out of it. But I think that speeding up, that's the other thing, speeding up the process of approving rate increases. None of us like rate increases, but until the market gets stable and until companies can see a profit, they're not going to open up and start writing business here in California. And those are some of the things that the state is working on.
So some questions are coming up basically about people's policies not being renewed, being given ultimatums or been given 3 months to find another carrier. Is this normal?
We're seeing a lot of that. John mentioned he's handling a lot of our apartment buildings and habitational stuff. But we're seeing a lot of that because, again, so farmers took some of the first steps in limiting and non-renewing some of our habitational stuff, but some other companies were kind of slow to it. So they were still absorbing some of the losses and actually taking on some of that more high-risk business that was unprofitable. So they are now having to withdraw from the market and start to cancel policies.
And then in that event, what do you suggest when someone learns that their insurance policy has just been canceled?
Well, so the first thing that you should do is not panic. So a lot of people start panicking, or they do two things. Either they panic or they put their head in the sand and they wait until the last minute to start shopping around for insurance. The first thing that you should do if you get a notice of cancellation from your insurer is to reach out to your broker. If you have a broker that you work with, reach out to them to find out why. What is the reason for that cancellation? In some cases, it could be that the roof is too old, or there's trees or limbs encroaching the property. Those things can be remediated, and maybe that policy can be saved. It could be a situation where that carrier is just withdrawing from the market and you have to go shopping. In that case, I'm happy to say that we've been very successful in finding coverage for some folks. But the main thing is to take action immediately.
And along with that, this question is for Tom. What happens from a lending perspective if the client is unable to get home insurance?
Well, the bottom line is that all lenders are going to require some, some form of hazard policy that covers their interests in order to fund a loan. So if you're in a purchase, we have to have a hazard policy in place that will at least, cover the replacement cost. In the situation where you have a mortgage and say your insurance gets canceled, if once the lender becomes aware of this, then they will usually, give you a grace period where the homeowner can find a new policy. If they put their head in the sand, like Albert was saying, and don't do anything, then the lender will bind mandatory coverage for them. And that's usually pretty expensive. So no one really wants to be in that spot. And then, that the owner still has the chance to find another policy and get rid of the mandatory one or retire it, but they are responsible for the fees during the time when that mandatory policy was in place. So I think the bottom line is as soon as you get the notice, you start working on a solution.
Mm-hmm.
And so I've experienced as an agent, clients having issues when there's knob and tube in a home, old circuit breakers, Pacific style, and so forth. Also copper plumbing. What kind of red flags do you think are most significant? Which ones do you think are a deal breaker, and which ones will insurance companies provide some time to remediate?
Good question. I'm gonna ask Jonathan. He's deals with a lot of them. I'm gonna ask him to chime in on some of this.
Yeah. So for the knob and tube is something that we see a lot. And the main carriers that are asking to see that are usually our bigger habitational, like our HOAs or apartment buildings or our multi-unit homes. Some carriers won't ask to see it, but if they do, and every insurance carrier will order an inspection, and the ones that do the on-site ones that look at the electrical circuit boxes and actually see the knob and tube is where we kind of run into the issue of they will send out a notice of cancellation, and they'll usually give 30 to 60 days to remediate that, to change out those electrical boxes to an approved manufacturer. And ones to note, and we can repeat this if you guys need, but federal specific stab lock panels are one that are known to have a higher risk of electrical fire. Knob and tube is another big one, and I think Zinsco is another one. So those are kind of the three big ones that we're always on the lookout that will need to be replaced for most, if not all, insurance carriers. So that's something to look out for when looking at your wiring in your home.
And just trying to piggyback on that, it's a question that we get a lot, if not every day. We get calls from people that say, "Hey, I've got this particular home, or I'm looking this particular home that has this issue." And the biggest issue that we see for residential are the old breaker boxes. People that have these old breaker boxes and have not updated them, or old plumbing or old roofing.
So actually, along with that question, I've experienced issues with this, and I think I know some of my clients have too. How old can a roof be nowadays? I think I've heard different things. Where there was a time when over 20 years old was actually fine as long as you didn't have significant claims. Now I'm hearing, I was actually given an ultimatum too by my insurance company that I had to replace my roof since it's over 15 years old, even though there were no claims. So what is what do you see where that is going?
Yeah, it's a good question. It really depends from carrier to carrier. The main thing for farmers, for instance, if the roof is an older roof and it's still in good condition, we can still write that policy. But that policy may have an actual cash value endorsement on it for the roof because it's an older roof. But they really like to see between 10 and 15 years in terms of their age. But if you've got an older roof that's, say, 20 years old, but it's still in good condition, we still should be able to help you with farmers. But if it goes really from carrier to carrier, the main thing is that, one, that roof is in really good condition still. Some people say, "Oh, it's old, but it's not leaking," but it's not in the great condition. There's where we're going to run into trouble.
And that's also another question, that has come up with my clients as well. And I think I've talked to you about this too, ET, where how do they know what the roof condition is? They haven't even seen your house, and then they claim that they have inside information on what's going on your roof. Like, how are they getting this information?
I will let you in on a secret that's not really a secret. Insurance companies have uh, aerial views about 99% of every structure in this country. And so even in some of the platforms that we're working on, while we're entering the information, it's pulling up pictures of the property, including the roof. So by the use of technology, insurance companies, they know what your property looks like, and it's a big issue. And so whether it's drones, whether it's balloons, whether it's satellites, if you've got an older roof, they're going to know about it.
So I'm going to go to one of the questions in the chat. And this is basically if you have all your policies under one carrier, so auto, home, etc. With various carriers bailing out of California, how do you pledge various policies, ensure that there is a cross-claim situation and that the various carriers will step up?
Well, that's the problem. So in the past, you could have all your policies with one carrier, and because you had those policies with that carrier and you've been with them a certain length of time, you felt a sense of security that you weren't going to lose your coverage. That's no longer valid anymore. So when insurance companies want to pull out and they're canceling, we see this a lot with State Farm and some of the other carriers. When they're canceling your home, whether you've been with them for 30 years, 20 years, and you have all the other stuff, they're going to cancel it because they're looking at pure profitability. So the good news, again, for farmers, that I want to share this, is that we are open for home insurance. We've effective this week, we're removing some of the barriers for auto insurance. So now we can start doing auto home combinations and things like that. And whereas we really didn't have that option because we had a 25-day delay, which turns to a 19-day delay. So people wanting to bundle insurance, there were some real barriers to that. So we're going to be in a better position moving forward for that. But again, when you have all your insurance with one carrier and you're thinking that's going to be your security blanket, that doesn't work anymore today.
So I'll get to the other questions in just a few minutes. Another thing that has come up with a lot of clients is, what are your insurance requirements post-close? Suppose you're in escrow, you're getting the home insurance, and the insurance company will give you requirements. In fact, I've worked with you and a couple of clients in this case, ET. So what are the primary ones that you can speak to?
Yeah, I'm going to defer to John for this.
Yeah, so just for the various, sorry, my audio cut out. You said the insurance requirements, right?
Yeah, so post-close, what are the insurance requirements?
Yeah, so for farmer specific is what we've kind of noticed over the past few years when Albert mentioned earlier about how different insurance carriers were pulling out of the market. Farmers has never had any plan to pull out of the market, and there's been no plan to pull out in the future. But with that being said, they have implemented new claim mitigation requirements depending on the value of your home. So for us, if your dwelling coverage or your building coverage exceeds 1 million, we have 4 different claims devices that we need proof of. The first is a whole house water leak detection device. And what that does is it's an automatic water device that hooks up to your main water line that will automatically shut off the water if it detects any change in water pressure. So if that's like a pipe burst or a leak or of some sort, it'll automatically shut off the water to prevent any further claims. The water claims have been the highest loss for any insurance carrier. So that's the biggest one that they want to mitigate risk for. And then also for these high value homes, they're also requiring an automatic gas shutoff valve. In the event of an earthquake, it'll shut off your gas. And then as well as a fire and burglar monitoring device, so just like a security system on your home. These are all requirements for homes that are exceeding 1 million, but any home that's older than 30 years requires at least the whole house water leak detection device. So insurance carriers, specifically farmers, in order to stay in the industry and stay in California specifically, need to make sure they can keep the water loss claims to the bare minimum, in order to keep servicing clients and being available, in California and the Bay Area too. So we've worked with a couple plumbers in San Francisco, but farmers actually also just recently partnered with Moen, who's been a big supplier for that water detection device. And we've had clients who, before we had that partnership, the device and labor costs, 1,000 to, when the demand spiked, it was, some clients were paying over $2,000 for the part, a $400 part and the installation. But Farmers was able to strike a partnership with Moen, and we're able to get, for most homes, depending on the size of your pipes, it can vary, but it's between $750 and $850 for the part and installation. So it's been a great deal, and it's helped hundreds of our clients kind of just get that device installed, and it's pretty seamless and easy to just get an appointment for that online. So those are the kind of four big post-bind requirements that we have through Farmers.
And I'm
Thanks,
going to
yeah.
just add to that. So the other factor that they're added on is if you've had a water loss at a property, even with a zero payout, they're also requiring that whole house leak detection device be installed prior to binding coverage. Or if you have a secondary dwelling. So let's say we have a primary dwelling, and now you also have a rental dwelling or a secondary dwelling. They're also going to be requiring that leak detection device be installed there.
And along with that, when does this inspection process usually happen, just to ensure that clients have the installation and everything in place?
Oh, that's a good question. I get this a lot. So there's two different things that's going to be happening. So on high value homes, there's always going to be an inspection. And so the inspection takes place within 30 days of binding coverage. That's not connected with the installation of the devices. They're not coming to inspect those devices. They're coming to inspect your house for eligibility and just to verify the risk characteristics, so forth. So a lot of people think, oh, but I'm not going to have those things installed because by the time they get here. Well, insurance companies have mandated that these homes be inspected within 30 days. That means that somebody's going to be contacting you within probably a week of binding coverage to set the appointment up. And so some people have been trying to delay that because they are worried that they're not going to have those things installed in time. Those are two separate issues. They're not looking for those devices. They're looking for other risk characteristics.
So another question that has come up, I'll just go to the chat real quick. And it's basically so there is a condo and someone is having, it was a pre-1906 building. They're having difficulty in getting insurance. Only one company is willing to insure. There's one online carrier, Honeycomb. Any strategies that you would recommend in this case?
Yeah, so Jonathan's been working a lot with the apartment buildings and HOAs. I'm going to let him answer some of the avenues we have for that.
Yeah, so just rereading that question, you mentioned that the only company willing to insure was out of state and not improved in California. And what those companies are referred to, there are surplus lines or not admitted carriers. And yes, it's true they're not necessarily approved in California, but all it means is that they're out of state and they're not, they don't have to abide by specific California-based insurance laws. The reason why you likely only had these carriers is we have this issue as well. If it doesn't fit Farmers, who has a very, very strict appetite now, we do have to go to our wholesaler who shops it to the non-admitted market as well. With that being said, our wholesaler, I'm not sure which broker you used, but our wholesaler only works with A or greater rated companies. And that's kind of referring to that credit rating Albert was talking about earlier for financial strength. So all the carriers that we work with, even though there may not be companies you've heard of, they all have A or greater rating of financial strength to pay claims. And we've had no issues with any of these carriers that have been through our wholesaler or non-admitted market. Honeycomb is a company we've also worked with as well. It's another online kind of company that's kind of more new to our stream, but they're an admitted company as well, with also a good financial strength. So if you're able to get a quote through them, either through us or on through your own means, it's been a great company for us. Admitted carriers do typically have a lower premium compared to non-admitted, just because non-admitted carriers take on a little bit more risk, and so they have a little bit more fees that tack onto it. The only caveat with that is Honeycomb has been for us very, very strict.
Mhm.
A good example is Albert's wife Lena. They have a property on Union Street that was able to get a quote through Honeycomb, and then just down the block on Union Street as well, one of our other clients, they got declined due to a high terrorism zone. So there's a bunch of different rating factors that go into it, and it's very strict. But if we're able to get a quote through Honeycomb, it has been successful for us. But when we can't get that, or when we have to go through the surplus lines or the non-approved lines, they've also been successful as well.
Thank you, Jonathan. I'll go to another question actually, which I've been asked as well a lot. And I think I've also experienced this personally, where I had brain damage at my home and was contemplating whether to actually make the claim. So the question here is, I had some brain damage and ended up only costing $2,500 to fix and have a 1K deductible. The insurance carrier hiked the premium the next year. Is it better? Am I better off to not file claims for minor damage?
I'm going to tackle this one, and I'm going to go back to Tom's. I had a question for him. So what I recommend people do, and we tell all of our clients, is every time there's a claims situation that you think it's a potential loss, contact us first. Let's go through and see what is the actual issue. How is it going to be handled? Is it potentially going to be covered? And is it worth putting in a claim in? Because with that very first claim that you put in, yes, you are going to be surcharged, and all claims count. So even if you put a claim in and you decide, oh, I'm not going to follow through with that claim, now you have a claim. And so it's best to talk to us or talk to your broker, find out whether or not it's worthwhile to put the claim in before you submit the claim. But my question also with Tom is, for some of the older buildings that we're seeing that are non-renewed and going through things, is there any issues with lending because of it's so much harder to buy insurance and things like that? Is there any issues with lending for older buildings?
Not necessarily. I mean, the way that we work is, well, first of all, we learn what we learn from about the property most of the time on the appraisal. And so whatever the appraiser sees and takes pictures of is what we're going to see. If a property has been well maintained and it's 1906, it's not an issue. If there's, but if there's cracks in the wall, or severe, like there's a severe slope to the store that's causing, or water damage or things like that, that are the same thing you would see when you look at a property, that's a potential problem, just like it would be, for a number of reasons, right? Well, what's causing the crack? What's going on? We are even okay with brick foundations as long as they're serviceable. So if there's no history of cracking, or a lot of times, again, when you look at the property and it looks like that the brick foundation is serviceable and is doing its job, we don't have an issue with that either. Whereas some lenders that were more portfolio, I remember Luther Burbank used to have a problem with them. If it didn't matter, if you had a brick foundation, unless it was completely encapsulated or you provided a big engineer's report or whatever, they wouldn't even touch it. So it all comes down to how well a property is maintained, I think, is really the answer.
Yeah, good. Thank you for that.
Sure.
I just want to follow up with that from an insurance point of view, is that one of the issues that we see out there when we're dealing with older properties and apartment buildings or HOAs or TICs, whatever it is that they have not been updated. You got older roofs, you got older plumbing, older electrical, you've got vegetation or trees growing to, right up against the structure, and they haven't made the investment in the property to maintain it and keep it up to date. So that's always a problem because, again, all these insurance companies are very risk adverse. They don't want to take on losses. And again, they're going to be in inspection within 30 days of binding coverage. And so, so my next question, just follow up with that with Tom, is what if you have a property like that that maybe have some issues? What kind of funding or lending or what options would they have to right away try to make changes or updates to that property to make it insurable?
So, I mean, the good news is that we have a number of programs available that allow clients to access home equity. And the type of program that they use is going to depend on, we have actual second loans or second mortgages or home equity lines for people that are self-employed where they can qualify off of business bank statements, for example. We have traditional HELOCs where you could go to us or a credit union or somewhere. And we have kind of a special fintech hybrid program that is super streamlined and quick funding. So the question, first of all, is how much do you need? How much equity do you have in the property? And how fast do you need the money? So if they've got like a 60-day window or a 90-day window to make these improvements, they might want to go through the standard underwriting process of, doing a home equity line of credit. It takes 30 to 45 days to close, etc. But if their back's against the wall and they need the money in 2 weeks, we have a streamlined program where not only it qualifies kind of like a personal loan or a credit card. We look at credit, job history, equity in the house, and we go off of an automated value model which means that, and this is especially important if you have people that it's a little separate issue, but if you have people say that are doing a remodel and they're coming up towards the end of their money, but they're not coming up towards the end of their remodel, which happens a lot, and they need a few extra bucks. If they still have a job and credit and sufficient equity, we can use one of these HELOCs to go in and get them another $100,000, $200,000 to finish the job. Because we go off of an automated value model, it's highly likely that an appraiser will never go out to the property and see that, there might be some construction going on. So that's a huge tool that can help people. But absent of that loan, you could have the money in 10 days in your account. So that would allow you to access what you need to take care of the insurance issues.
Excellent, thank you.
Super useful. So another question that's come up a lot is, suppose someone has tried all avenues for insurance and they're left with a California FAIR Plan. What is that? When should clients consider it?
Yeah, it's a good question. So the California FAIR Plan is the insurer of last resort. Although now in recent years they've been the go-to market. In fact, I have people that reach out to us for insurance quotes and they say, "Hey, should I just go to the FAIR Plan?" So that's not should never be your first option that I've been non-renewed, let me go to the FAIR Plan. Because the FAIR Plan is meant to be the insurer of last resort because it's minimal coverage. It's important coverage, but it's not meant to cover all things for all people. And another thing is going back to properties not being in good condition, the FAIR Plan doesn't take everything. If your roof's not in good condition, if again you've got growth around your home and things like that, that makes your house an increased hazard, they won't insure it either. And so we've had a case where the property has been kind of let go and submitted to FAIR Plan, and FAIR Plan has declined it. And so we've had to clean it up a bit, and we've gone through other measures to get coverage. So the FAIR Plan is an important part of the equation for higher fire risk areas, so people can get insurance. And we use FAIR Plan regularly, but the FAIR Plan also needs a companion policy to go with it, whether it's just a liability for premises liability or a companion policy to fill in the gaps of what's not covered by the FAIR Plan, such as water damage, theft, falling objects, and things like that.
Thanks, CT. And Tom, along with that, can clients still get financing if that's all they're able to retain is the California FAIR Plan?
Oh yeah, absolutely. I mean, lenders don't really look per se at a given company as much as they look at what the coverage limits are and that their interests are covered. So if they can get adequate, replacement cost coverage from the Fair Plan or any other company, we're fine with that.
And another question I have is, what should a seller do in this insurance market? If they're getting their home ready for sale, they're aware of all these challenges with insurance. What would you recommend that they do?
Yeah, so I really recommend it's just like a home, someone is staging their home or prepping their home for sale and all that. Look at the main systems of the home. Those main systems are very important. And some people say, well, what's the main system? The roof, the plumbing, the heating, and the electrical. Those are the main systems of a home. So just as you want to put coat a paint on, or you want to stage the property, try to make your home as insurable as possible. That, to me, that's critical. So if you know you've got a roof that's 30 years old and that's going to be a problem for the buyer, maybe you do something about the roof. If you don't have the funds, again, like Tom was mentioning, a home equity line, some way of financing to take care of those major systems that's going to be obstacles to the next person.
Yeah, that's super useful. A question that was asked by one of my seller clients recently: can they transfer their insurance policy over to the buyer?
Yeah, in a perfect universe, but insurance, and here's the thing that happens in today's insurance environment. Insurance, your insurance history stays with the home, but it also now travels with the person. So where so it's buyer specific or person specific, and it's property specific. And so you cannot transfer. So someone buying my property cannot just automatically take over an existing policy. So it has to be underwritten to that person. So as an example, what if in my last property, I had a couple of losses? So, well, those losses travel with me to this new property. And so the insurance company underwrites it for the individual. But now, let's say I've got a clean record and the owner of this property had a couple of losses, which we recently discovered for someone. Well, those losses also count for that property. And so the new buyer, the new owner, now has to pay the excess premiums for the claims by that previous property owner.
Another question that has also come up is earthquake insurance. That is also a question on the Q&A. How is the earthquake insurance market? When should someone consider getting the earthquake insurance? It seems like it's challenging to get someone to underwrite catastrophic coverage for multi-unit condos in the Bay Area.
Well, those are a couple different questions. So you can buy earthquake insurance for a standard home through the California Earthquake Authority. We also have individual carriers that we work with that we can also get insurance through. But our go-to, if we're writing the policy directly through Farmers, it's going to be the CEA. If we're brokering it and writing it outside of Farmers, we have other carriers that we can work with. And for multi-unit buildings, it's more challenging. So we do have options for that, but the age of the building and the condition, if it's been retrofitted, things like that are going to come into play. Where I recommend people buy insurance is in areas where there's liquefaction in San Francisco. If you've got an older property that maybe has an older foundation and things like that, and it's close to a potential earthquake prone area, definitely I would consider looking at earthquake. The thing to know about earthquake is that they've also made some changes so that there's deductible options. You can go as low as 5%. You can go as a 25% deductible. And so I highly recommend earthquake, and we do write earthquake, every month for people in various categories.
Thanks, CT. So another question which came up, which is related to what we were chatting about earlier, insurance staying with the property and insurance traveling with owners. Is this a new development? It seems unfairly skewed.
Oh, I'm sorry, one more time.
Insurance staying with the property and insurance also traveling with the owners. Is that a new development?
It is a new development, but it kind of makes sense, because if you're a person who puts in a lot of claims, then you're at this property, you're probably going to put in a lot of claims on the next property. And then also, if this property had multiple water losses, it could be that this property's got some plumbing issues. And so insurance companies now are really paying attention to that kind of thing. And they're not, again, they're very risk adverse. So they're not wanting to come into a situation where they're automatically going to start taking losses. And so that's why the insurance counts for that property and also travels with you to your next property.
So another question that has come up is how do claims impact the saleability of your home and your future purchases?
This just goes right back to it. So as an example, someone that we did a quote for had multiple losses on that property, all within a 5-year period. And so we were able to get a quote, but a quote that normally should be maybe between $25,000 and $3,000 came in just under $8,000. Reason being those losses. So obviously that's going to affect your ability to sell that property, because the people have to think about, wow, if it's all within 5 years and these things stay on your record for 5 years, I'm going to be paying a significant amount for insurance for quite a while based on the prior owner's history.
Yeah, and also you are asked, during a sale, you're asked to basically report any claims you made in the last several years. So
yeah, well, five years is what they're looking at these days.
So another question that came up recently, which you helped my client with, thank you, ET, was they forgot to renew their policy. They had this policy for 30 years. Unfortunately, they forgot to renew it. So in this situation, if you can just talk about, did they have to start off with a new policy and kind of what was that process?
Well, yeah, so thanks for allowing us to be of service on that for that gentleman. But this does come up. It comes up for us within our agencies that people, my wife does her very best to try to send reminders and reach out to people. And sometimes people just don't pay attention. But if you forget to pay your insurance premium, that's not good news, because you had a policy for 10 years. You may have had it for 15 years. Well, once that policy cancels, no insurance company allows you to reinstate anymore. So that means you're going to start off as a new client. That means under new rules, new underwriting, new rates. And even though insurance rates have been going up over the last couple of years, it's still based on your prior premium. So it goes up in a percentage of that rate. But if you're coming in fresh, then that means you're going to be getting the current rate as a new client. And so we do our best to try to stay on top of these kind of things, but we really urge people you get something in mail, and a lot of people are numb to this because they get a lot of junk mail from different sources. But when you get something in the mail from, whether it's an email or a letter from an insurance company, you really need to open it. So see what it says.
I agree, especially in this environment that we're in right now. So another question that has come up is about redwoods. Do we think that redwood pergolas would have to be removed? Are they considered like trees?
Well, the thing is that we've been seeing is where we've got trees that are too close to a structure. Either they're too big or they're too close, or there's limbs hanging over the property. Now, in high fire zones, they have a whole list of procedures that people have to do for high fire zones. But I'm just talking about just around the Bay Area, in our areas, from what I've seen. I see people that fall in love with trees and they don't want to take trees out, and they've gotten cancellation because there's too many trees too close to the property. But you got to look at it like this. What is more valuable, your home or the tree? And so if insurance company sends you a notice saying your property is being non-renewed because you've got trees too close to your home, or they don't like that particular tree, my best advice is to get rid of the tree, because if that insurance company doesn't like it, the next one won't like it either.
And
So,
ETF, sorry, Ramina, I'm
okay.
just gonna chime in on that too, because I think the question was referring to the pergolas, like the outdoor kind of structures that people can install. If it's just a separate structure like that, so it's not an actual tree or something, it's like an overhang, I'm guessing you can put like seating area or like grills or something other or whatever. Those are fine. You can actually also insure for that. We have an option to add separate structure coverage. So what that is if you have like a deck or a patio or like a pergola or something, or even an ADU that's not attached to the structure, there is coverage for that. What Albert was referring to for the trees is if you have like a tree in your front yard or your backyard that's either touching the structure or too overgrown, that's just a fire risk that they'll want either chopped away from the brush, or in some cases, rarely, they'll want it entirely removed depending on the height of the tree and the risk of it falling over. But that's kind of what we do for the separate structures, at least.
Thanks. It's super useful to know.
Just to add to that, what's really important is to really to let your agent or broker know how it's being used. So a lot of us, we see a lot of ADUs, additional structures, coming onto the market, and we're getting a lot of those. And so it's important to note whether it's going to be family member or is it going to be a rental, because it's important to have that properly rated on a policy.
So a question that came up, which I think we were going to talk about more about the wildfire risk, is that someone's insurance was recently doubled because your neighborhood was reassessed for fire risk. Should they try and shop for a new carrier, or should they just assume that most carriers will assess the risk similarly?
Yeah, every insurance company kind of looks at this a little differently. I've had people reach out to us and been non-renewed because of increased fire risk, and we were able to get them a policy. So the main thing is, if that's the case and you're being dramatically upcharged, yeah, reach out. You never know. Every insurance company kind of views it a little bit differently. What's acceptable to one carrier may not be acceptable to another. So you got that. In that case, you have to do your due diligence, find out, if there's other carriers rating it that way. And there's where we put our broker's hat on and we reach out to other carriers to find options.
And along with that, how does insurance kick in when there's a natural disaster and your home becomes uninhabitable?
Yeah, so that's that important loss of use coverage. And we saw that in some of the wildfires. So when you're in a case where you're having to either evacuate, there's coverage on your policy for that. Or let's say, which unfortunately we've had that during some of the wildfires like Paradise and up in Santa Rosa, where people actually lost their homes. And that loss of use is really important coverage. Sometimes when we're putting out quotes and people say, oh, what can I reduce on my coverage? The thing that you don't want to reduce is that loss of use, because if it takes a year or 2 years to rehab your house or rebuild your house, you want as much loss of use coverage as possible. During the Paradise, we had people, the great thing about it is right away, within 24 hours, we're able to get people into hotels and then get them into rentals and things like that. If you don't have adequate loss of use, or you don't have loss of use on your policy, then it's all on you. You're going to self-pay for everything.
Thank you, ET. So another question that has come up recently from some of my investor clients is, why should I mention to the insurance company that I'm not living in the property or that I'm renting out?
Well, we've been doing this a long time, and we've seen it all. So the problem is when you take on you buy a property and you buy it as a primary residence, but you're actually going to be using it as a rental. Now, Tom could probably speak to this in terms of cost of loan and lending for primary versus rental and all that. But the problem is when you lie to your insurance company about the use of the policy, then it's misrated. And in the event of a loss, let's say that tenant has a fire loss and they go out to adjust it and they realize it's a tenant living in there, it's not owner occupied, then that gives the insurance company the out to rescind from the contract. And so you thought you had insurance, but really what you had was a piece of paper that said insurance, because the only thing they're obligated to do is give you back your money. And say that there is no insurance because of material misrepresentation. So that's why you need to be honest about that. So I would ask Tom, why would people want to do that from a financial point of view?
Well, I mean, I guess typically it's because owner-occupied rates for mortgages are much lower than investment property, because basically all lending is based on risk. And so when a lender has a box and they say, this is my box and I'll buy anything, I'll buy any loan that'll fit in this box, there's different ingredients to the loan, or there's different characteristics of the loan, like you're baking a pie, and the fees associated with each ingredient or each characteristic is different. And so that's why when you an investment property is seen as more risk than a owner occupied, so it's going to carry what we call a higher delivery fee for that component. And so they can get into similar trouble with the lender if they find out that they bought it as a primary residence and immediately started renting it out. I mean, the lender could, I haven't seen this happen very often, but it's possible that, the lender found out 2 months later, that they weren't living there, that they could call the loan due. So it's pretty serious.
I sometimes get that question from people, and my response is, well, I've got to sell you the right type of policy. Is it, well, will my lender care? And so I always wanted to ask that question: will the lender care if they're taking the loan out as a primary residence, but they provide a landlord policy for evidence of insurance?
Well, if we catch that in underwriting, which we will, because we see what the coverages are, that's going to open up a question with the underwriter. The underwriter is going to say, well, if you're living in this property, why do you have a, renter's coverage? That's obviously different for 2 units, because you can live in 1 unit and still have rent the other unit out and have both. But if it's a single family, that's going to be a big red flag.
Yeah,
for sure.
So another question that has come up quite a bit, considering the value of a lot of homes, especially in the Bay Area, is how do I ensure my coverage limits are adequate to rebuild my home today? Considering since building costs have risen since the homeowner probably first purchased a property.
Yeah, we see this for people that have been in a home for a long time, and all of a sudden their insurance has been non-renewed, and they're living in a 2,500, 3,000 square foot home, and they've got $600,000 worth of coverage when they really need double that amount of insurance. So it's important that the property owner review their insurance periodically. And insurance companies, at times, they're going to make adjustments to the building costs, but it's not going to be huge adjustments. And we've seen the cost of construction and things like that really climb quite dramatically. So it's really important that people review their insurance. If you haven't looked at your insurance for a while, it's time to look at it. And if you're grossly underinsured, then talk to an insurance agent or broker. Reach out to your existing broker or carrier and see if you can update it. Make sure they run a current replacement cost estimator on your home to make sure you're adequately insured.
So we only have a few minutes left, but I'll go to the final question. And for anyone else who's asked questions, since your name is there, we'll go ahead and email you. So the question is, how does subrogation work in a multi-unit high-rise? Another unit has caused water damage to my unit, and I file a claim with my insurance and pay the deductible. Can I go after the other unit's insurance to recover the deductible?
Well, I get this from time to time. So, and it really depends on the cause of the loss. And so people assume if the loss originated from another unit, they're automatically liable, but not necessarily. They have to be negligent. If I'm cooking bacon, I leave the bacon and it's on and it starts to burn and there's smoke damage that also then causes damage to my neighbor's unit, so forth, due to water or smoke or fire, whatever. I'm negligent, so that's a liability issue. If there's simply a ruptured pipe, which is act of God, after whatever, through no fault of that person, that may not be something you can subrogate against. And we've had people that say, "Oh, I want to go after that other person's insurance," so they try to put in a claim against their neighbor's insurance, and then it's declined or denied because they're not liable. There's no negligence.
Thank you. Actually, I think we have quite time for just one last quick question. So we kind of touched upon this. Is it true that insurance companies are using drones to assess roofs and other items? And they're sending people without notice as well to assess insurability?
Right. Well, that's called reinspection. And so every insurance company is reinspecting properties. And so you can expect that. That's why it's important to maintain your property, maintain the surroundings of your property, because just assume that at some point the insurance company is going to be looking at my property using drone, satellite, like I said, all the various technology available to assess my insurability and if my home is still eligible. And so we've had a lot of it over the years where we had roof inspections done where people said, "Oh, my roof is only 10 years old," but the imagery shows that roof is not in good condition. So regardless if it's a new roof or the roof is still within 10 years, that really doesn't matter. Is the roof still in good condition? So from time to time, maybe you have a roofer go look at it. There's a service that you can get on your roof. It may cost you a couple $1,000s, but they clean the roof, they assess the roof and make sure the roof is still in good condition.
Thank you. So we are going to wrap up here. It's 12 o'clock. Thanks so much, ET, Tom, and Jonathan. And everybody, we will be sending out this recording and also our contact information if you'd like to contact us after this meeting. Thank you so much again for joining.
Yep. Thanks, everybody.